Biz Ed 123, Financial Management, Team 1, Take 1, and Action.
I think we're team 3, right? Yeah, team 3, all right. All right, so hello everybody, we're Alex, Justin, and Mike. We're Chapter 3, Analyzing Financial Statements. So the first topic that we're going over we're going to go over is perspectives in which financial statements are viewed. So first off, you have the stockholders who focus on net cash flows, risk, rate of return, and the market value of the firm's stocks. Then we go to the managers that focus on the rate of return, efficient use of assets, controlling costs, increase in net cash flows, increasing in market value of the firm stock, and job security. And then creditors, who focus on the predictability of revenues, expenses, and the ability to meet short-term obligations, the ability to make loan payments on schedule, and avoidance of changes in risk. Analyzing financial statement practices. Understanding, so we have like 4 things for it. Understanding from which perspective you'll be analyzing the statements. You can use audit statements for correctness. Understanding trend analysis requires the use of statements from 3 to 5 years back, benchmarks to competitors of similar size or similar products and services. And a benchmark is a standard or a point of reference against which things may be compared or assessed. Cool. All right, so common size of financial statement. That's important to know because we all need to know that if we're going to be CEOs and CFOs in the future. Common size of balance sheet standardizes the amount in a balance sheet account by converting the dollar value of each item into its percentage of total assets. Dollar values on a regular balance sheet provide information on the number of dollars associated with the balance sheet account. And percentage values on common size balance sheet provide information on the relative side or importance of the dollars associated with the balance sheet account. Common size of the income statement. Expenses each account as a percentage of net sales and is the most useful way to compare a common size of an income statement. This allows financial analysis to better compare firms of different sizes and to analyze trends in a single firm's income statement accounts over time. All right, so we have some financial ratios. The financial ratios are what establish a common reference point across firms. Even though the numerical value of the reference point will differ from firm to firm, ratios obviously make it easier to compare the performance of large firms to that of a smaller firm. And ratios also make it easier to compare the current and historical performance of single firms as the firm changes over time, which is known as a trend of analysis. All right, so we have some things that we're going to go over throughout this presentation. We have like 5 types of common ratios. We have the liquidity ratio, efficiency ratio, leverage ratio, profitability ratios, and the market value ratios.
Okay. All right. So short-term liquidity ratios. Short-term liquidity ratios focus on whether a firm has the ability to convert current assets into cash quickly without loss of value. In general, higher ratios are a favorable indicator that a firm can accomplish this. So the current ratio is current assets over current liabilities. Quick ratio is current assets minus inventory over current liabilities. Efficiency ratio. The efficiency ratio or asset turnover ratios measure how efficiently a firm uses its assets and indicate a firm's ability to use assets to produce sales. Generally, higher numbers are favorable indicators, but for days, sales, and inventory, a lower number is favorable. So inventory turnover is cost of goods sold over inventory. Days sales in inventory is 365 over inventory turnover. So efficiency ratio continued. Accounts receivable turnover is net sales over accounts receivable, and days sales outstanding is 365 over accounts receivable turnover. Assets turnover ratio. Total asset turnover measures the dollar amount of sales generated with each dollar of total assets. Generally, the higher the total assets turnover, the more efficiently management is using total assets. So total assets turnover is net sales over total assets, and fixed assets turnover, net sales over net fixed assets. Do you guys want us to slow down so we can copy this, like some of the formulas? No? All right, go. Leverage ratios. Leverage ratios measure the extent to which a firm uses debt rather than equity financing. This indicates a firm's ability to meet its long-term financial obligations like interest payments on debt and lease payments. Higher ratios usually indicate greater potential return and greater bankruptcy risk. Yeah. There are your ratios. Coverage ratios, another type of leverage ratio which measures the firm's ability to service its debt, or how easily the firm can cover its debt payments out of earnings or cash flow. A higher coverage ratio indicates a lower bankruptcy risk and the possibility of a lower potential return. Times interest rate. No, you're good. Profitability ratios measure management's ability to efficiently use the firm's assets to generate sales and manage the firm's operations. These ratios are of interest to creditors, stockholders, and managers because they focus on the firm's earnings. Generally, the higher ratio indicates better performance, gross profit margin.
So there's more profitability ratios. You have net profit margin, EBIT, which is earnings before interest and taxes, and EROA, which is, and you have return on assets and return on equity. Those are the rest of the profitability ratios. And so the ratios we've looked at so far rely on a firm's financial statements, and much of the data in those statements, they don't represent the current market values. So market value ratios combine market value data with data from a firm's financial statements and indicate how the market is valuing the firm's equity. Higher ratios indicate a greater shareholder. So you have earnings per share, price to earnings ratio, and the market to move ratio. So the DuPont system is a diagnostic tool that firms use that it uses the financial ratios to evaluate the company's financial health. It's used by shareholders and management to understand the factors that drive return on investment, or ROE. The process has 3 steps. Management assesses the company's financial health using the DuPont ratios. If any problems are identified, management corrects them. And the 3rd step in the process is management monitors the firm's financial performance over time, looking for differences from ratios established as benchmarks by management. So the ROA and ROE equations are right here. ROA is net profit margin times the total asset turnover, and ROE is the ROA times the equity multiplier. So once you have those 2 equations, you combine them into a single equation, which is called the DuPont equation. So the first one is ROE equals net profit margin times total asset turnover times the equity multiplier. And you can also express that in a ratio form listed here. And the DuPont equation basically tells us that a firm's ROE is determined by the firm's operating efficiency, profitability, and its use of financial leverage. So benchmarks are standards for the basis of meaningful comparisons of ratios and ratio analysis. Firms and financial managers select benchmarks, and they gather benchmark data through trend, industry, and peer group analysis. Trend analysis is using history as a standard and basically evaluating a single firm's performance over time. An industry analysis is when you take like an aggregate, where you kind of compare like similar firms in the same industry to sort of use that as a benchmark to see how your firm's doing. And the standard industrial classification system and the North American industry classification system are 2 kind of like databases that a lot of companies use to when they're doing industry analysis. And then the last benchmark is peer group analysis. It identifies a peer group of companies and uses their financial information and average ratio values to compare performance. So there are some limits to financial statement analysis. Financial statement and ratio analysis is dependent on accounting data that's based on historical costs, but managers would rather use financial statements that are based on the current market values of their assets and stuff, which better reflect the firm's true economic condition. And it's not an exact science. There's kind of a lack of theory that guides us in making judgments based on financial statements and ratio analysis.
All right. Cool. Thank you all for listening.
straight to the board and start putting up the solutions. And then you're gonna do the presentation and walk through this. So what I'm going to do is I'm going to hand out every week, like today's Thursday, I'm going to hand out problems, and then you have a whole week to study it, and then you come in on Thursday, right off the bat, you go right to the board, and you start putting up the solution. And then what we'll do is within like 15 minutes, we should have the board full of problems, then we'll spend like another 15, 20 minutes just going around, and you guys are doing a 2-minute presentation on the problems. So we'll do like a ton of problems in this class. So when you walk out, I do this in all my other classes. It's the first time I've done it in this class. But I think it's a really helpful exercise. You get to learn the math and the problems. You're not like grinding through trying to figure out how to solve the problems because I gave you the solutions. And you go right to the solutions. You learn the problem, you learn the solutions. You memorize it, boom, you're on your way, you learn the stuff. So I'm not a big proponent of, you can do one of these this week, next week, and then one the following week. I'm a big proponent of looking at these solutions. Obviously, if you read the chapter, it helps too, but it's not this is not rocket science. Rocket science is rocket science. That's chemistry and physics, and we're not in the engineering departments, we're in the business school, so it's a little bit easier than being in engineering. I'm a big proponent of you read the problems, you put up the solutions, and you memorize the problems in the solutions. I mean, when you go and you sit for the CPA exam, do you think that you will have studied maybe 2,000 or 4,000 problems before you sit for the exam? Yeah, absolutely. The CFA exam, same thing. The bar exam, same thing. Series 7, 66, 27, 6, 3, whatever, all those exams. Same thing, you're studying tons and tons of questions. The real estate broker's exam, I memorized 2,000 questions. So you gotta learn how to memorize, you gotta learn how to do the solutions. If you do it right, it becomes permanent memory, you'll remember the stuff forever, which is totally key. The ones that I would like you to do are circled. If the problem's really easy, put a couple problems up. If the problem's really complicated, just put one of them up and then move on to use the next problem, which may be complicated, and do it the next time around. Can you guys, can you pay attention, please? Thank you. I'm going to run short of patience at some point if you're not focused. Okay. So here are some problems. Again, they're not rocket science. You have a whole week to study them. I've given you the problems and the solutions, and a lot of them I actually have diagrammed where you get the solution, so it lays it out for you. So usually right when you come into the class, I have a bunch of problems here. So pick, maybe one or two of them, and then use the problems that you didn't get to for the next weeks. Okay. So I gave you kind of an inventory of problems. Same thing with this one. So use them over a couple weeks. Some of them aren't very hard. So if you want to put a couple of them up or a few of them up, that's totally cool. Okay. I'll leave it up to you. Some people like to do the least amount of work, other people like to do the amount of work that they can handle. And then some people push their capabilities, just like if you're an athlete, you got to push your physical and mental capabilities to be able to perform at a very high professional level as an athlete. I played rugby for 10 years. I played on the top teams. What did it take? I worked my butt off constantly. Okay. So with the workload and the work effort that you put into it, you're going to get a lot out of it, okay, if you're interested in this area. Finance is an extremely powerful area of business. It's usually marketing and finance that runs the business. Marketing generates the revenue, and finance figures out how to finance the marketing plans and the expansions and those things. So they work very closely together. Okay. So that's the philosophy, and we'll see how it goes. I would, next Thursday when you walk in, I would just go straight to the board, grab some highlighters or borrow some. I'll try to leave some here when I can, but everybody steals them. And then just come right in and start putting your problem or problems up on the board and get ready to make the presentation, okay? I think it makes it for more of an interesting class instead of me going around and just boring you to death, because I can only write, so fast, and I can only present so fast, and I find that when the students, do these kind of interactive activities and these labs, it gives you practice on how to make problem presentations in front of senior level executives, boards, investment committees. You'll be jumping up in front of people all the time when you go work, and they're going to expect you. If somebody doesn't understand what you're saying because you're waving around your hands, they're going to ask you to go up on the board and do a diagram and diagram it out. Put up the mathematics, give us an example, show us an example. So you got to get really comfortable jumping up, making really many presentations, and being able to communicate to other individuals and communicate these concepts to them. Yes?
So I'm kind of connect the dots here. So the syllabus says homework number 1, it has a bunch of problems. Is this the solutions to one of those problems?
Yeah, actually I went through the solutions guide for the homework, and I picked out the problems that I felt would be good for you to work on. There is solutions to the homeworks within there. And I already provided you the solutions to the homeworks. Okay, so there's no reason, now you have no reason not to do the homework, right? Because I already provided you with the solutions. I couldn't get to the homework, it was too hard, I got stuck. I was spending too much time, I got stuck, I couldn't get through the homework, there's no excuse. Okay, so it should be able to cut, the amount of time that it takes to actually do the homework. Us going over the homework problems will cut the time period in doing the homework, so the homeworks become a little bit easier to accomplish. And you're learning the solutions and the questions and the solutions the correct way. I'm a big proponent of that. It's really hard to sit down to do the homework and try to figure out all this stuff. We don't do that stuff. What we do is we find problems that are similar to what we're working on. We see how other people have solved them in the past, either by best practices or standards or other creative solutions. We look at our problem and we basically apply their solutions to our problem to get to the solution quicker, because what we need to do is to get to the solutions quicker. We don't have time. Time is money. It's expensive to be wasting time getting stuck and racking your brain to move through stuff. You learn how to solve things the right way. You look at it, you study it, you move on to the next thing. It's just a consumption of knowledge is what it is. Okay? Yes, did you have a question?
Yeah, so when is the memo due?
I like to see the memos as soon as possible. You should be doing a draft of the memos. What I would do is I would scan one of the memos and I would convert it from PDF into a Word. And actually it does a pretty good job of doing it. So that way you're not messing around with the formatting and stuff like that. So isn't there optical converters, or isn't there software out there that will convert a PDF to a Word? Is there? Have you Googled it? Yeah, of course. That's a quick way to do it, and then you update the data. You check it, you come to me, you say, hey, Professor Sousa, take a look at it. You change the data and the analysis and the bullets, you swap out the graphs, and boom, you got the template pretty much done. You got the format basically already in place, and then it's just a matter of studying, the articles that you're reading, coming up with a view. Is it going to go up or down, by how much, over what period of time? What trade, derivative trade sets, are you going to use? You update the data. It just makes it a little bit easier than trying to do it from scratch. Okay. And I find people who do it, try to do a lot of the stuff in this class and probably other classes, when you try to do stuff from scratch, it takes a lot longer and you're probably going to make mistakes, and then you go through this iterative process. I like to usually provide templates to people and then trust them that they're going to take those templates and they're going to go through the exercise, as opposed to just plagiarizing, the template. And I've read all those memos like 50 times. So I've read like the memo's like 1,000 times. So I know if the data's stale or if you're using somebody else's language, because sometimes there's some grammatical mistakes within those bullet points, and I remember who did it. So I have a really good memory, almost a photographic memory in some cases, so I remember a lot of the stuff that I see and hear, and I remember people's faces, but I don't remember people's names. I need to build relationships with people first to remember their names. And that's another thing you may want to think about doing, is come to visit me, talk to me, build a relationship with me so that I remember who you are and I can advocate for you, not only in the class but outside the class. Did anybody have any other questions? No? Okay. Did you have any questions on the pre-test? I know some people had some questions. They were actually some of the blank spots on the pre-test were the hardest areas of the pre-test. You wouldn't know that unless you had some experience in working, in research or working with data or model building at some point in time. That's really what I wanted to. One of the exercises of the pre-test is not only to refresh your memory of data analytics, data analysis, but also to start you thinking about how would you respond if your supervisor or your senior executive within the firm asks you to build a model. What would you do? How would you approach it? What questions would you ask? What would be the approach? You can't say no. You can't say I don't know. But there's a series of questions that you would ask, which are appropriate, that you need to ask if you don't know how to do it. Okay. Yes.
Just a clarification.
Yeah.
Do you mind if like the circles mean?
Yeah. The red is you didn't attempt it. The blue is you got probably 75% of it.
Thank you.
Or maybe 65 to 75 or 50 to 75 of it. There were larger gaps in it, so you needed to put a little bit more effort into it. And then green was basically perfect or nearly perfect. Okay.
And do we, once we like fill it out, does that get changed or is it as is?
Once, if you got a green, then as we go over some of the questions today, you may want to add in some of the nuances, but I would say at least 50% of the class, nailed it. They did the research, they found the right answers, they put in the definitions, they had the equations, they had the diagrams. I mean, it was just beautiful work. I mean, it's awesome. So you're pretty much done. If you got a green, or some of you, I gave you the green, but you needed to, I mentioned and I showed where you needed to add a little bit more detail or where you needed to go find a little bit more work. Like the portfolio standard deviation is a perfect example. I mean, Alexandria had totally nailed the whole thing. She just didn't have the full portfolio standard deviation equation. She had the standard deviation equation. So some of the other students helped her out. She got it. She's on her way. She's done. Okay. So when you work in groups, you can work in high performance teams. You can check each other's work and then make sure that you're doing it correct. Okay. People who have tried to do my class on their own don't do very well. They get discouraged. They usually don't show up. And then I have to chase them down, a month before the class ends, to get them, back on track. Okay. All right. So did you have any questions on the pretest? I know some of you did. Yes, sir.
Yeah, I was gonna say, the one that kind of confused me with the time series regression.
Yeah, sure.
In terms of how you would use that in
Yeah,
analyzing
sure.
stocks or companies.
Sure.
I mean, I found something that maybe is right, but I'm not.
No, that's great. Okay, so here's what I learned and the way I did it. There's two types of regressions. There's time series regression, which means that the variables, the variable, you can have data for the variables over time, quarterly, annual, whatever the time series is. Preferably you want to have at least more than 20 time periods, because you want to have a normal distribution from the data to be able to do the regression. Okay. So what I've done in the past is I would rather use time series regression to do the forecasting of whatever the dependent variable is, but I don't have enough data. So if I'm working with a startup company, and I'm trying to forecast sales or revenue or returns going forward. We've only been around for maybe 2 years, so I only have 8 quarters, data. That's not enough. But what I can do is I can go out and I can find 20 firms that are similar to ours, or maybe 40 firms that are similar to ours within our sector, and use the firms within one period of time to run the regression to get the coefficients to do the forecasting. So I can use the cross-sectional regression as a short-term solution to a long-term problem. And then within 5 years, 5, 10, 15, 20, in 5 years I got 20 data points at a quarterly basis, so I can now use the same coefficients within a time series to project the sales, the production, those things. So cross-section is you're using multiple firms, the same variables, but in one period of time. Okay? Time series, I'm using one company, the same variables, but the variables over time. That's the difference between the two. Okay?
Okay.
Does that answer the question?
It
Do I
does a
need to
little bit,
diagram?
but sort of, I guess, how would you, the part that says how would you use that, and like, so like
Got
that's when you would use it and why
Got
you
it.
would use it, but
Got
like physically, how do you use it?
Yeah, that's it. The solution is I would use cross-sectional regression as an interim solution to using time series regression because I don't have enough time. I don't have enough time data.
Okay.
Okay, so the example is I have a startup company, only been around a couple years. I got 8 quarters of data. I don't have at least 20 data points. I'm going to use, but I do have 40 companies similar to ours. So why don't I just use the 40 companies, the same variables in one period of time, and run the regression equation. And then once I get the, I guess it's better to draw it out. And I'm going to use just I'm going to use a 3-variable model here. So let's say I'm trying to forecast sales. So I know that one of the variables is going to be orders. I know that one variable is going to be maybe GDP, growth rate, some kind of macro factor. The other is going to be some projection of customer demand. All of those variables seem to make sense. Do they seem to make sense?
Yeah.
Yeah, exactly. So what I would like to have is for my firm, I would love to have the data from time 1 to TN. So I'm going to have basically orders per quarter. Here, I'm going to have GDP growth rates per quarter, and I'm going to have consumer demand metric here per quarter. So that way, and if I have historical sales per quarter, I can run the regression. I'm going to get the coefficients. Once I get the coefficients, I can forecast consumer demand, I can forecast GDP growth rates, I can forecast future orders, and I can forecast the sales for a company. Okay. The other is, if I don't have enough time for my company, what I will do is I will use one period time, and I would use, instead of the sales, I would use sales growth for firms. Firms in N1, N1 firms to, yes, N firms. So I'm doing, what were the percentage change per quarter, okay, on average for a year for each one of these firms for the last year? What was the GDP growth rate on average for the last 4 quarters. Okay? What was consumer demand per quarter over the last 4 quarters? So you standardize the data for each of the firms, and then the sales. You run the regression using cross-sectional regression using firms instead of time. I get the coefficients from the cross-sectional regression analysis. Then what I do is I forecast the consumer demand, the GDP, and the orders, and I can forecast sales for my company. So I was using cross-sectional regression to get the coefficients to then put in the forecasts to forecast the sales. Instead of having my historical time series. Cross-sectional regression, I didn't have enough time series data, so I used firms, similar firms. For time series, I had the time for the variable regressions to get the coefficients and then do the forecast to forecast the sales. So the cross-sectional regression analysis could be a short-term solution due to lack of enough data that you have. You have enough firms, but you don't have enough time series. So you run the cross-sectional regression to get the coefficients to do the forecast of the sales. And then when you do have enough time series data, then you convert from cross-sectional to time series, and then do the projections again and then forecast it out. You would only know how, the only way that you would know that is if you'd ever done it, okay? So what I was trying to do with some of these questions was to add in some of the things that I've learned over the last 25 years and how to build the models and get around some of the constraints, okay? Any other questions? Yeah.
Oh, I had a question about how to select and determine variables in a model.
Yeah, the dependent and independent. Yeah. So usually you kind of know what the most important metrics are, depending on what industry, you know, and what company you're working for. Obviously, if I work for Cisco, you know, we sell a lot of telecommunication chips, you know, routers and those things, or even components for the routers. So we're going to know that we're going to need, my friend did this, she was the scheduler for Cisco, and she would do projections of demand in the marketplace for those switches. And when she made those projections, she went to the Cisco senior managers and she said, I'm forecasting a total vertical demand curve. I mean, our sales in these chips when we bring them out are going to go from 1 million to like 40 million. And we're going to need to have a supply chain put in place. And you're going to need to fly me to China to basically be able to set up with the chip manufacturers in China the ability to provide us with the 4 million chips that we are going to need. Because our demand for that product is just going to go through the roof, and we're going to need to outsource through the supply chain. We'll be able to manufacture a certain degree of them through Intel and others, but we're going to need to bring the suppliers in, and we're going to need to go vertical. So it's really important, you know, that you will know if I'm trying to forecast, you know, switch sales or switch production. If I'm trying to forecast switch sales, I'm going to have to forecast switch demand. So sales, revenues, production, you know, those are usually the personnel or the key dependent variables for all firms. Profits, earnings, cash flows, those are all the main metrics, the dependent variables that you're going to want to forecast. If I was an economist, I would be forecasting GDP and industrial production and unemployment and, you know, macro factors. And some of those macro factors that I forecast can also go into this model, okay? So the dependent variables are usually driven by the metrics of the firms, which is usually profitability, or cost containment, or production, or sales, or revenues, or free cash flow growth rates, return on the stock. Those are all the most important dependent variables. The independent variables, one, through internal validation, is what are the standards that have been used? What are the variables that have been used in the past to forecast the dependent variables that have actually worked, that have done a good job of forecasting the dependent variable? So usually internal to the firm, there's institutional knowledge and experience, and they will know what's going to drive chip sales. They will know what variables based on their experience drive the sales and the revenues and the earnings and the returns. So one, you need to be in contact with people within the firm who have experience and ask them, what variables do you think should be in the model to do a good job of forecasting the telecom chips or the switch chips. Okay, that's one. The other is that there's probably been research reports that have been written in the past, either by industry professionals and industry scientists, or academic scientists or academicians at research institutions. So you're going to have to go to industry journals to find those research reports, to look at the research, to find the models, to find the variables, to find the data that they've used and what the results of that research were, and how you incorporate that into your model for external validation purposes. And then you would go to the academic literature, to the library, through ProQuest, EBSCO, other sources of peer-reviewed journal articles. Do a search, on how do you forecast telecom chip technologies. There's going to be tons of research that's been done at the major research institutions on a global basis. You find the articles that are relevant to what you're trying to do. You look at the models that they built compared to yours. You look at the variables that they came up with that were predictive. You look at the data that they used, and you take basically both of those internal and external validations to build your best model. Then you build the model, you test the model, you look at the regression diagnostics, you forecast the outcomes for the model, and then you forward test and you back test your projections to see how your model did and actually forecasting historically, and also as you're forecasting out every quarter, you're going to check your model to see how accurate it was, and if it's pretty accurate, then you have a really good model that you can use to then recommend to the board and to senior management to implement as a standard forecasting model for your chip sales. And if you're right, then you'll be a hero. Okay. You'll still be a hero because a lot of people don't know how to do a lot of this stuff, and just going through this process will give senior management a lot of insights, into the process. Okay. Any other questions that you had? Multicollinearity, I think, was another issue. Always did. I think it was 2 or 3 questions that were listed on multicollinearity. Multicollinearity is when you have 2 variables that are highly correlated to each other, but also correlated to the dependent variable. And since you have a multicollinearity, I got 2 variables that are correlated to each other, that also correlated to the dependent variable. I don't need one of them. I don't need both of them. I just need one of them. How do you select the one to keep and which one to throw out? Most students would say I would keep the one that has the highest correlation with the dependent variable, and which one is giving me the highest t statistic. That might be random just based on the data sample that you're using. You want to use the variable that's been cited the most in the academic and industry literature over and over again, over time, using different data sets. Okay. So this one's been cited the most, you use this one. This one, hasn't been cited the most or not cited at all. I'd probably throw that one out. Because you're going to be asked in the meeting, how did you build the model? Why did you use this model structure? How did you come up with the variables? And you got to be able to defend yourself. I threw this one out even though this one had a higher t statistic, was more correlated to the dependent variable. This one was cited the most in literature, not only in the peer-reviewed journal articles, but also in the industry research. And oh, by the way, here's a list of the peer-reviewed journal articles and the industry research reports that actually validate not only the model, but also validates the variable. Okay? Okay, any other questions on the exam? Yes?
Can you go over question 14 where it says show 4 intrinsic valuation methods and following?
Yeah, sure. All right, so the first intrinsic valuation method, we'll get into this even more as we go through the class. And we can, do you guys have calculators? Why don't you pull out your calculators so we can do an example. Anybody want to borrow a calculator? If you don't have a calculator? Here's some calculators here. I think I only have 3. I'll bring more to class. Again, I would do the BA2. You might want to share with them. But always bring your calculator. When you walk into the meeting room, I'll give you a little advice. When you walk into the meeting room, I would always get there a half hour early, never be late to the meeting. You sit down, you're gonna put your pad of paper right here, you're gonna have your computer right there, you're gonna have your cell phone here, you're gonna have your cup of coffee there, you're gonna have your calculator there, and maybe your tablet there. You're gonna be totally teched out, okay? And you're gonna be totally prepared, okay? You'll be able to calculate stuff, you'll be able to pull stuff up, you'll be able to, maybe you got another meeting going on simultaneously and somebody's texting you something. You're going to be using the technology. Okay, so always bring your stuff. Always be ready. So the perpetuity model. Is the first of the intrinsic valuation models. And actually, a lot of these questions, you're going to see not only in the pre-test, but you're going to see them on the exam too. There's like pieces that are all scattered that are going to be on the exam. So the perpetuity model is very simplistic. It's cash flow next year. And these are the nomenclatures. These are my nomenclatures. So this is cash flow. And cash flow could be dividends. It could be earnings per share. It could be EBITDA per share. So if I'm going to be using these, if I'm going to be valuing share prices, stock prices. If I want to value a firm, earnings, total earnings for the company. I'm going to use total EBITDA for the firm. Earnings before interest, taxes, depreciation, amortization. This is also called free cash flow. So these models can be used to not only value share prices, but also used to value companies. So this is your cash flow. And we don't care about this year's or last year's cash flow, we care about next year's. What's your projection? So next year's cash flow. Divided by I is going to be the value using the perpetuity model. What is I? Well, I is the discount rate. We're learning discounted cash flow, okay? We use discounted cash flow methodologies. I'll walk you through that. So this is the discount rate. This could also be the expected return. By the investor. This could always also be the capital asset pricing model, which equals the risk-free rate plus the beta times the return on the market minus the risk-free rate. This equation right here gives you is one way of calculating the expected return, but it's also the cost of equity for the firm. So if I'm looking to buy a company, I'm going to look at their free cash flow for next year projections, and then we're going to divide the free cash flow projection by our cost of equity to get the value of the company. Again, we'll go over this stuff over and over again. And then the other method is calculate the discount rate. is the weighted average cost of capital. So I'm a company, I'm gonna use how am I financing our liabilities, 70% debt, 30% equity. Okay, those are my weights. I use the capital asset pricing model to come up with my cost of equity, and I use the yield maturity on our bonds to come up with the cost of the debt. Okay, I know you don't know a lot about this stuff right now, but you're gonna be reading the book, you're gonna be learning it, we're gonna go over and over it again about 100 times during class. The weighted average cost of capital is the weight of the equity times the cost of the equity plus the weight of the debt times the cost of the debt times 1 minus the tax rate. I can deduct the interest on the bonds as a tax shield. Acts like a tax shield for us. And then what are these weights? Well, the weight of the debt is the value of the debt, which the value of the debt is going to be the number of bonds in the marketplace times the price of the bonds. So that's going to be the value, or the market value. The market value of the debt. Okay. And if I divide the market value of the debt by the market value equity plus the market value of the debt, which is the total market capitalization, so the value of the bonds divided by the value of the equity plus the value of the debt, which is called the total market cap, is going to give me the weight of the debt. If I take 1 minus the weight of the debt, I'm going to get the weight of the equity. Most companies are financed with 70% debt and 30% equity. It's just a rule of thumb. Okay. And if I'm a startup company, my cost of equity is probably around 20 to 30%. If I've been around a long time, it's probably 8 to 10%. And bonds, since they have the first claim on the earnings, right? Because I got to pay the bondholders before I pay the dividends to the shareholders. Since they have the first claim of the cash flows, and also the first claim, the bondholders have the first claim if we ever go bankrupt. They're going to liquidate the assets of the firm, and they're going to pay off the bondholders first. So the cost of debt is a lot cheaper than the cost of the equity as a rule of thumb. And that's usually around 4 to 5%. Okay? So these are rules of thumb. So that's basically the discount rate. And in the perpetuity model, you assume that these cash flows are going to remain flat into perpetuity. So they're just going to be constant over time. So what happens is the equation decomposes into this simple equation. So next year's cash flow divided by your discount rate is going to give you the value of the share or the value of the company using the perpetuity model. So we can do easy math, right? If we do 10%, $10 is going to be the earnings per share for next year. 10 plus 1, and our discount rate is 10%, and the value of the share is going to be $100. It's just a very simple equation. Okay, if this goes up, that goes up. If that goes down, that goes down. If that goes up, that goes down. If that goes down, that goes up. So you have to memorize the logic, okay, in your brain. Okay, so that's perpetuity. Gordon growth. Gordon growth is very simplistic. Gordon growth basically says, okay, what I'm going to do is now I'm going to assume cash flows aren't going to remain flat forever. They're actually going to grow at a constant rate. So when you assume that the cash flows are going to grow at a constant rate forever, the equation decomposes to this very simple equation. It's cash flow next year divided by the discount rate minus the growth rate. Okay. So I can do, that would be GG. This would be Gordon growth. So I can take the same equation, think that earnings per share is gonna be $10 next year. We're looking at a newly IPO'd company. Their cost of capital, or the expected return by the investor is gonna be 20%. And we think that the earnings is gonna grow at a constant rate at 10% per year. Minus 0.1. So this product decomposes to 0.1. So the value of the share is gonna be $100. It's just a simple way of doing it. Okay. Those are some examples. And you should write these down in your in your pre-test, because this is the question that's on the exam. Okay. So you'll already have one section of the exam done. You already have the derivative trades done. You've got the model, the multicollinearity, external, internal. That's the first problem on the exam. Okay. So I'm kind of checking off some of the exam stuff right now. Okay. The third method is the multiple approach. This one takes the same cash flow for next year. It multiplies it by some multiple So this one's a linear equation. Okay? So the question is, what's the multiple? Okay? So I can use the stock price divided by the earnings per share. So this is also called the price earnings multiple. Or the PE. Or the PE multiple. Now I can calculate this for the firm based on our projections, or I can go look at other similar stocks, similar to ours, in the marketplace and look at what the PE multiple is currently today. So if the current earnings per share is $10, or my projected earnings per share for next year is $10 per share, my earnings per share is $10 per share, multiplied by price earnings multiple. So let's say the price is what? $100 divided by 10. It's going to give me a multiple of 10. Which means that the stock price using the multiple price is $100. Obviously, if the multiple that I think for the firm is going to be 20 next year, or my earnings per share is going to be higher for next year. This is going to be what, 50? Price to earnings multiples. I can also calculate a multiple using 1 divided by the discount rate, which is 10. 10%, so it's going to give me 10 times. 10 times 10, it's going to give me 100. So I can use and this is the same as the perpetuity model. So I can calculate, and I can also calculate a multiple using 1 divided by I minus G. So I can calculate, well, yeah.
Yeah, how'd you get 500 then?
50 times 10.
Isn't it 5?
Oh, yeah. Sorry about that. Thank you. So that's another way of calculating the multiples. You can use multiple approaches to using the multiples. The last method is the discounted cash flow method. your DCF. This is the value using DCF. I'm just going to use a 2-period time. 1 plus I to the 1, 1 plus I to the 2. It's going to be cash flow T plus 1, cash flow T plus 1. So this is just in cash flow CFO T plus 1 equals cash flow T equals 0 times 1 plus some growth rate. I'll give you an example of this too. Okay. So here are the 2 cash flows, okay, for the 2 periods. And then what we want to do is we want to add the terminal value to this last year's cash flow. I'll do an example of this. So to get this terminal value, is cash flow. This is T plus 2. This is cash flow T plus 3 divided by the discount rate is going to give you the terminal value. So what you want it to get cash flow 2 multiplied by 1 plus G. I'll do an example of this. And then to get cash flow T plus 3, I'm going to grow this cash flow T plus 2 out 1 plus G. I'll give you an example of this. So the cash flow in period 3 divided by the discount rate is going to give you the terminal value. You add the terminal value to the last year's cash flow. And then you're going to discount all these cash flows back to the present to get the intrinsic value using the discounted cash flow approach. So I'll show you an example. You'll have to calculate the answer for me, okay? So let's say that the cash flow, where should I do this? Let's do it over there. Do an example. And you guys do the math for me. So cash flow T equals 0. Let's say the earnings per share is $10. Year 1, year 2. This is going to be the value using discounted cash flow. Let's say we think that the earnings per share is going to grow at 20% from this year to next year. So what we'll do is we'll multiply $10 by 1.2. What does that give us? 10 times 1.2? 12? So we're going to use 12 for the first year's cash flow. And we think that the cash flow is going to grow another 20% through to year 2. What we're going to do is multiply that by 1.2. So it's 12 times 1.2. What is it? 14 point. Got it. So now we got the second year cash flow. And we might as well go ahead and get ready to calculate the terminal value. So let's say we think that the cash flows are going to slow between year 2 and year 3 and only grow by 10%, or 1.1. So what's 14.4 times 1.1?
15.84.
What is it?
15.84.
Thank you. 15.84. Great. Okay, so now we got the cash flow set up. And since we're buying a small company, our expected rate of return is going to be pretty high. So I think what we expect when we're looking at these companies and we look at these shares for these young companies, we want at least a 15% rate of return. And let's say our cost of capital is 15%, so we're gonna use 15% as the discount rate. So 1.15, 1.15 to 2. You know that 1.15 to the 1 is 1.15. What's 1.15 squared? So 1.32. Use that. Got it. All right, excellent. So what is 12 divided by 1.15? Now we're taking the discounted cash flows. We're discounting the cash flows. And these are, you want to make sure you make a note of this. This is the discount factor. Okay. These are the discount factors. So what's 12 divided by 1.15?
10.435.
What is it?
10.435.
So 10.44. Got it. So we got the first year's discounted cash flow. Now we need the second year. Well, we have the cash flow. We're going to get the earnings per share. We need to add in the terminal value. So what was our expected return? What was our cost of capital? What was our discount rate that we used? 15%. Usually later on in the class, what I'll do is I'll use a higher discount rate because the further out in the future, there's more risk and uncertainty, so we use a higher discount rate because of the higher risk. Okay? But we'll just, for simplicity purposes, use the same discount rate. So 15%, we're going to use, here's the other thing. You want to assume that the cash flows are going to remain flat forever or grow at a constant rate. Grow at a constant rate because it's a tech company. Okay. So let's say we use the 15% and we use 0.02. We think that the earnings are going to grow at 2% forever. So this becomes what, 0.13? So we're going to take the $15.84 and divide it by 0.13 to get the terminal value. What does that give us? It's 1584 divided by 0.13. You should all be on your calculators calculating this.
121.84.
What is it?
121.84.
You have to, you need to be calculating this stuff. You have to start practicing your calculator calculations. So then we're going to take the 121.84. Add it to the 14.4. And what does that give us? So it's 14.4 plus 121.84.
What's that, are we adding it to the 14.4?
Yeah. Yeah, you're going to add it.
But why?
Because the theory is that we can sell the shares at the end of year 2 based on our expected growth rates and our expected returns. This is basically the value. This is going to be the value of the share at the end of year 2. Okay. So what we want to do is that when we sell it, this is what we're going to get at the end of year 2. So we want to add that cash flow to the other earnings per share that we're getting in year 2. Okay.
Where
So-
did that 0.02 come from?
We just came up with that.
Wait, so those two numbers are both just like.
This is going to be your expected return. So any company that I buy, we're going to require a 15% rate of return. Or the cost of equity or the weighted average cost of capital is 15%. So they're going to give you that. Or you're going to come up with it yourself. Okay. We think that the company that we're looking at, we think that the cash flows after year 2 are going to grow at a constant rate of 2% per year. So this is your I. This is your I minus G. So we're using the Gordon growth law. this was the, last year the earnings per share was 10%. We grew it out at 20% and got to 12%. We thought that we could grow the earnings out again by another 20% in year 2. Then we thought that earnings growth rates were going to slow to 10%. So we grew the 14.4 by 1.1 to get the 15.84. Okay. Did you get that?
Yeah.
Okay. And then you take the 15.84 and you divide it by 0.15, which is your expected return, minus your constant growth rate, which is 0.13. 15.84 divided by 0.13 is going to give us 121.84. And we're going to take the 121.84 and we're going to add it to the 14.4. And that's going to give us,
136.24.
what did you get?
136.24.
Did everybody get that? Okay, great. Now what you do is you take that total cash flow that you're going to get in the last year of the holding period and you're going to divide it by the discount factor. 1.32. So what is 136.24 divided by 1.32?
103.21.
103.21. Got it. So then this is now your discounted cash flow. This is your discounted cash flow of the cash flow from the last year in the holding period. That's the terminal value. You're going to get the total cash flow divided by the discount factor for year 2, get the discounted cash flow for year 2, 103.21. Then you take the discounted cash flow for year 2 and add it to the discounted cash flow for year 1, and you're going to get the present value. Or the PV, or the intrinsic value. Or the share. And that's going to give you the value of the share. And what do you get?
113.65.
What is it?
113.65.
113.65. So that's the value of the share. Okay. And these could have been, instead of earnings per share, this could have been earnings in millions. Instead, we would have come up with 113,650,000 for the value of the firm. So I can use this equation to calculate the value of the share for the company, or the value of the company itself, based off the total earnings.
Could you do this for any amount of years, like a terminal value?
Yeah.
is always like-
Yeah, I can use, this is just a 2-year holding period. When we do this later on in class, we'll be doing it maybe 3 years, but most of the scenarios that we use will be 5 years. And then when you go work someplace, you'll be doing all this in an Excel spreadsheet. And if you're working for like a venture capital firm or a private equity firm, they'll be using maybe 3 to 5 year holding periods. And when you go work for a large institutional investor that may be looking to acquire another company, what they'll do is you'll probably do a 10-year projection. We don't have time to go out 10 years and do it. That's why I just, yeah, 2 years is really short. This is a really aggressive private equity firm would do a 2-year scenario. And then a 3-year scenario would be more value add, opportunistic. And then 5-year, and then institutional investors use a 10-year, what are called pro formas for the cash flows. They use 10-year projections. Okay, and then they don't go beyond that, okay, unless you're doing something very special. So let's say that this is the earnings per share. This is what we're going to learn in class. We're going to go over this like a ton of times. But let me just walk you through the logic really quick. So if we come up with a value for this share of $113.65, current price, of the share is $100 per share, would you buy it? You're coming up with a value, you're valuing the share price of this company at $113.65. The current price, currently in the market is $100.
No.
would you buy it?
Yeah.
Absolutely. You would buy it. And if we were doing a stock valuation, this would be our recommendation, would be a buy recommendation. And if I think that the price is gonna go up, the share price is gonna go up in the future, could I buy the share price on margin to make more money? Could I buy calls on it? Buy calls on it? Yeah, I could write puts on it. So I could actually trade derivatives based off the equity research that you just did. Okay. And then what we'll do in the class is we'll do like a bunch of these things, real life scenarios. We'll do the perpetuity model, we'll do the Gordon growth approach, we'll do the multiple approach, we'll do the discounted cash flow approach, and then we'll weight the values from the different approaches to get a weighted average value. And that'll be our final intrinsic value that we compare against the current stock price to get the recommendation to then make the trades, recommendations to the proprietary trading unit, or make these recommendations to your clients. Based on our research, you should buy the stock. Any other questions on the pretest? We did multi-linearity, we did dependent independent variables, we did the perpetuity model, the Gordon growth, the multiple approach, the discounted cash flow methodology. I think that should get you guys in a pretty good shape. How much time do we have? How much? Okay. Why don't we, I can give you some high level for the quiz. Okay, let's start on the quiz because the pre-test is done, right? So now we can start working on the quiz. So let's talk about the exam and get right into it. And I would take notes on this. And then what I'll do is I'll go through in a little bit more detail since we don't have time today to do it, because I wanted to make sure you were on really solid footing with the pretest. You guys all did a great job. I'm sure you guys have done a great job too. Just let me know if I can help. Okay? So when building a forecast model, what are the first steps or questions that need to be taken? This is really important. I haven't gone over this yet. So you need to write this down. This is really critical. And so what are the first steps? Okay. So let's do a little role play. So your boss comes to you, or senior manager or board of directors, or somebody comes to you. You've noticed you're extremely talented and motivated. And they say, hey, we need to build a sales forecast model. Can you do it? What's the first thing that comes out of your mouth? Yes. Okay. What's the second thing that comes out of your mouth?
How do you do it?
Exactly. How do you do it? So how would you do it? Have you done this before? So the person who actually asks you to do it, you use them right off the bat as an advocate, and you ask them, have you done it before? Have you done it? And what variables, what model structure and what variables would you use in the model? So you just pick their brain right off the bat. Okay. And then what's the third thing you ask? When do you need it? Exactly. And then what's the fourth thing you ask? Am I going to be doing it by myself? Or do I have others that I'll be working with? And then the fifth thing you ask is, how much is it going to cost? Do we have the data internally, or do we have to purchase the data? And what's the budget? Because we're going to need a budget for the data, and we'll need a budget for the people that are going to be working with us. Okay. So those are the critical questions that
Could you just run back through?
Yeah, sure. So the first thing that the person's going to do is they're going to come up and they're going to ask you, we want to build a forecast model. Can you do it? And the first thing that comes out of your mouth is yes. The second thing that comes out of your mouth is yes. Have you ever done it before? And what variables do you think should be in the model? Would be driving sales going forward. So you pull them right in. And then the next question you're going to ask is, when do you need it? And then the next question you're going to ask is, am I going to be working by myself or with other people? And then the next question you're going to ask is, do we have a budget? Do we have the data, or do we have to acquire the data? And do we have to hire people from outside to work with me on it, or are we going to use people internal to the firm? So those are really important questions. And what you'll learn, and hopefully you learned it from me and others here, is when somebody comes to us with a problem, we just start asking a ton of questions. Okay, so we get a totally clear view of what the problem is and what we're trying to solve. Okay, and the second is, how do you determine the dependent and independent variables? Well, usually the person who comes to you is going to tell you what they want to forecast, but in some cases as a consultant, they really don't know what to measure. So they're coming to you as a consultant and say, hey, we need help in our company. We want to hire you, as a consultant. First thing, what are the variables that or metrics that we should be looking at and we should be forecasting? Well, obviously, overhead costs, burn rates, and expenses, profit margins, revenue growth, earnings growth, production levels, sales levels, all of those are dependent variables that would need to be forecasted. And some are actually dependent on each other. You have to forecast the others before you can forecast the sales. The independent variables, you're gonna ask people internal to the firm and get them bought in. So you'll do a survey of the key people internally that have the knowledge that would know what the independent variables are that would drive, let's say, sales. Okay? And then you're gonna go out and you're gonna read industry research reports and you're gonna read academic research papers to, again, find the variables and find the right model structure for you to use. And the data, when you get the data. How many variables should be in your model? No more than 5, okay? No more than 5. If you have more than 5, you run the risk of multicollinearity. The statistics start to look good, the adjusted R-squares and the F-stats look good when you have a lot of variables in there that are highly correlated to each other. So you want to limit no more than 5, okay? Less is more. So you want at least a minimum of 2, maybe 3 variables, but no more than 5, okay? How would you test for variable and model significance? Well, you would test the T statistic for the independent variables. You would use the F statistic for the model variable. You would use the adjusted R-square, as the correlation of the independent variables to the dependent variables. There's also a P statistic that you would use, a Durbin-Watson. There's other regression diagnostic statistics that you would use. I was looking for mainly the T, the F, and the adjusted R-square. And a lot of this should be reviewed for you if you've already taken the stats course. If you haven't, you're going to be confronted with this stuff, there. So it's better to get it here, walking in, having some knowledge of it, or this is just reinforcement for you. If you were experiencing multicollinearity in your model, if you had 2 variables that were highly correlated to the dependent variable and correlated to themselves, how would you decide which one to keep and which one to throw out? You would keep the one that was statistically significant or had a high correlation with the dependent variable but was cited the most in the literature. Okay. What is external validity? Internal validity, what's external validity, and how would you achieve both? Internal validity is you're getting really buy-in by people who have expertise within the firm that are validating your model and buying off on it. That's internal validation. And you'll need that. Okay? If there's anybody in your firm that is obstructing you from moving forward because they have a certain view, that could be a political issue for you. So you're always constantly trying to get buy-in by people around you so that you have advocates and you have resources. And then external validity is the industry and the academic journals where your model and your variables have been validated through those external sources of information. Okay? How am I doing on time?
2 minutes.
2 minutes? Okay. Why don't will you remind me to do the next one, because I have it already written out. But the next question is extremely important because we've never been here before where the Federal Reserve's balance sheet went from 250 billion prior to the financial crisis to basically 4.5 trillion today, and that's pretty much the case for all central banks across the world. So we basically live in a highly leveraged economic and financial environment, and we've started to see the volatility in bond and stock prices, and we're just waiting for it to occur in the real estate market. We're actually seeing some effects in the real estate market currently. So we have to analyze the balance sheet, okay? And then I'll go through the yield curve dynamics with you, which we already went through. The next question on the S&P 500 will be really quick. The next question, D, capital and commodity markets. We did that every class, right? We talked about the Dow, where oil prices are, gold prices, the bond yields, where the dollar to the pound, dollar to the euro is. I want you to put the data in there to show me that you're tracking the markets. And if you can give me some reasons why they're going up and down, that would be great. The dynamic supply, asset class supply demand analysis, that's gonna take a while. That's about at least a half-hour lecture, maybe longer than that. Financial product innovation and engineering, there's a link to that lecture on the website, okay, in the syllabus that you may want to review, especially marketing students and digital media and entrepreneurship majors, along with finance majors, review that. And then I'll go through that, that'll be like an hour. Modern portfolio theory will be an hour. Derivative trades, that'll be like 10 minutes. We already went through, reviewing the memos. And then the technical analysis will be pretty quick too. That's about a 30-minute lecture. The intrinsic valuations we just went through, but I'll go through the equations again, and then we'll work through some problems, some discounted cash flow problems. And as you do those, they're pretty simple, and I did provide you with the solutions to those too on the website if you want to start reviewing the quiz. Okay, so it looks like a lot. It is a lot, but I think you guys will be able to handle it. We'll work through it. We'll do some presentations on Tuesday. I'll lecture on this stuff on Tuesday. You'll come back on Thursday. We'll do some problems on Thursday, maybe some more presentations, and just get into kind of a rhythm and move through the material. Okay? If you have any questions or comments or suggestions or criticisms or any of that stuff, I can take them, and anything to make the class better, I'd appreciate the input. Okay? Thank you. Yes, sir.